Hello. We end 2025 in a supportive environment for risk assets. At the same time, deep structural changes are forcing investors to rethink the way they allocate. There are questions around global fragmentation, AI-led capex trends, equity market concentration and a depreciating dollar, to name but a few. Our 2026 outlook, which will be landing next week, highlights our expectations for the year, as well as the best ideas and top convictions from our chief investment officers, portfolio managers and research analysts. And I'm pleased to say that I'm joined by some of those bright brains today. CIO for Equities, Niamh Brody-Matura. Our Fixed Income CIO, Marion Lemborehek. Global Head of Multi-Asset, Matthew Quaife. And our Global Head of Macro, Salman Ahmed. Thank you all for joining us today. Before we start, just a reminder to all those watching that you can use the Q&A function to ask any questions to our panel throughout the discussion, and we'll try to answer some of those as we go along. Now, before Salman and I come to you to set the macro scene for 2026, I have a quick question for the asset class heads that we have collected here. A short reflection, if you will, on the year that has been. I'm going to ask you just briefly for the one thing that you think has been most significant for markets, for shaping markets in 2025. Niamh, if I start with you.
Seb, I think for equities, the answer is really clear. There's been one trend that has been so far ahead of all of the others that really there is only one possible answer, and that trend has been AI capex. So if we cast our mind back to this time last year, in Fidelity, we did expect a good outlook for markets in the coming year, business-friendly administration in the US, AI effects expected to spread out across the economy. We were concerned about the risks on the trade side, but we saw constructive policies coming through in other parts of the world. But what has really surprised on the upside through 2025 has been the developments on AI capex. If we remember back to January, we had the Stargate announcement from the US with public-private partnership at a huge magnitude. Then we had DeepSeek in China. But what's been really significant is through the year, consistently, the messaging on AI demand has been really, really strong. So you've seen it come through with multiple use cases, with usage numbers actually rising, and you've heard that supply is constrained, which means that the companies have been reporting that this is a really good environment. We're
definitely going to come back to the topic. Marion, for you, 2025.
Well, actually, 2025, fixed income has delivered its promises. If you look across, the different fixed income asset classes, we've had positive returns, limited volatility, steady performance across, fixed income. And I would say probably the most important factor it's been the year of credit. Really strong performance of credit, whether it's across different geographies, but also investment grade, high yield. If you look at the global IG performance, it's been 6.7% with a spread compression, obviously. Asian high yield has delivered 8.6% at the end of October. So really strong performance of credit across the spectrum. But even government bonds actually have delivered good returns, 6% for US Treasuries. Interest rates have been going down significantly in the US. And emerging markets has been actually also the best performing asset class with more than 11% EM sovereigns.
Thank you. Matt, for you.
Well, obviously, those two have affected my multi-asset world a lot, but I'd probably add policy over the top of it. Often multi-asset world is defined by growth and inflation and monthly data, but this year you've really got to be on top of the tariffs, on top of fiscal policy, on top of elections and different things that have really driven multiples. And you can't just watch the data, you've really got to be on top of what's going on in the world.
Thank you. Well, definitely lots there that we will, I'm sure, come back to in the discussion. For now, Salman, let me hand over to you for the macro backdrop.
Thank you very much. So let me share with you how we are thinking about 2026 from a macro top-down perspective. As my co-panelists talked about the observations of 2025, from a pure macro perspective, as I think Matt mentioned, the structural changes in policy which are in play are likely to shape both the macro environment, the geopolitics, the geoeconomics environment for multiple years to come. And 2026 is going to be an important one as that new regime starts to bed in. Yes, so let's start with the first slide. This is our proprietary leading indicator, what we call the FLY. So if you look at the overall composite FLY, it has been stable. No indications or warning signs of an imminent recession, which gives us confidence that the global economy is holding up. Of course, there are regional differences which are taking shape, and that's one of the major implications of the policy shifts we are seeing, especially international trade policy coming from the US, that regional growth profiles can start to diverge. But overall, a lot of components are in stable territories, and this is an important indicator we watch to understand if there are any imminent recession risks which are arising. If I go to the next slide, financial conditions have been incredibly easy. In fact, we would argue now that we are in a world where the causality has shifted from macro to markets towards markets to macro. And Neve talked about AI and the importance of AI. Certainly, if you look at financial conditions in the US, they are incredibly easy, but mostly driven by equities. And that has macro implications as if anything happens to that story. And just digging deeper into some of the core macro trends we're looking at in the US, there is a de-link happening between CapEx in the US, which has been very much shaped by AI expected demand and what the hyperscalers are doing, but also the labor market. The labor market is slowing. Now, similar thing happened during the bubble years as well. But the AI technology itself, as we know, is at its core a labor replacement technology. So we have to watch that de-link quite carefully and how the central banks will respond to that, which is at its core a productivity shock, but also creating negative implications for the labor market. Another way to look at this causality in the US is that the equity ownership of US households is at all-time high levels. And if you look at the consumption patterns, the top quartiles of income who also tend to hold a lot of equities are the ones which are really driving US consumption. You see that in the aggregate data, but the strength is very differentiated, unlike the pre-pandemic years. And you see a proper differentiation across income profiles where you can see the impact of the wealth effect in play. And then if you look at, for example, the state variables of debt, that's where I think we are in a much better position than the dot-com bubble, which is that the private sector is not that levered. The corporate sector in the US is not leveraging like crazy, although there are some signs of synthetic leverage coming in. I'm sure my fellow panelists will talk about it as we go along, but overall, it's the public sector which is leveraged a lot. And this is something we will have to watch very carefully in 26 as the debate about Fed independence becomes real. There's been a lot of threats and a lot of shots fired, warning shots fired, but the real crunch will come when we get to May, when Chair Powell has to step down. Eurozone, very quickly, we're seeing signs of a pickup in growth again, led by credit as ECB policy easing is passing through the system. The fiscal policy support from Germany is likely to kick in a more stronger way as well. What happens to that also depends on geopolitics. Russia-Ukraine is still an open-ended war. So the settlement, any settlement there may have implications as well for Eurozone and defense policy more specifically. And then lastly, on China, I want to share, we were in the camp going into 25 that this is going to be a year of controlled stabilization, despite the risk about trade and tariffs, because we were picking up signs that the policy is gearing towards stabilization and the policy support is coming through towards supporting domestic demand. We're still seeing that in the data, although more short-term data has shown some signs of weakness, but credit growth is there. It's focused on domestic demand, but this is a multi-year story. The Chinese authorities and the Chinese policymakers will have to keep supporting domestic demand growth in China to offset these tariff risks, trade war risks, and more importantly, the structural change in their economic model away from property. So that's going to be an important theme again, once again, as we go into 2026. So that's in a nutshell how we are thinking about things as we look into 2026. Thank you.
Thank you very much, Salman. And I want to pick up a little bit on CapEx and earnings expectations, particularly around the AI story. You've argued here that markets are beginning to influence the macro outlook in a more substantial way. What exactly has changed in your view?
So I think the size of the CapEx is a macro-relevant CapEx now. So hyperscalers going to, let's say, 500 billion by 2030, which seems to be the projections. Those are big numbers. Remember, these numbers are less than 100 billion pre-2022. Then there's a multiplier effect of that. And then if anything happens to that story, for any reason, that is going to become a macro issue. Then the second related point is that the consumption cycle is also getting affected by stock prices, as we saw from the ownership numbers and the consumption patterns of high-income households. So again, this virtuous flywheel can turn into a vicious flywheel if the market comes under pressure. So as I mentioned, this is the first time we're seeing in a while where, as macro folks, we are more interested in equity markets rather than the other way around.
And talking of equity markets, Niamh, obviously this is all very closely tied to market concentration. What's your view on that challenge as we head into 2026?
Thanks, Seb. Let's start with the S&P. For 2025, clearly, as we've already discussed, huge parts of the gains have been driven by AI and AI-related stocks as well as resources. So now, from going into 2026 position, you've got over a third of the US market is in tech. Clearly, that's attracting an awful lot of attention. Clearly, it is, as Salman mentioned, having knock-on effects and reversing some of the relationships that we would expect. However, there are a couple of important factors to bear in mind here. Firstly, the fact that it's concentrated doesn't necessarily of itself mean that that will reverse. I would be careful of ascribing a halo of hype to this when you consider that the tech sector really has been the dominant driver of both earnings and cash flow for the market, not just in the US, but globally through 2025. So we need to reflect carefully on that part of the market. Now, having said that, I do think we've good conditions for a broadening of the market into 2026. There are a few elements to that. The first is you've got corporate tax cuts in the US, which will surely be helpful. You've got a positive rate environment, and that does tend to help the more small and mid-cap or economically sensitive parts of the market. From our side, we are interested in diversifying for our clients. We think that is really important. So again, as I said, concentration doesn't necessarily mean that that's going to change overnight, but we do think it's important to be thoughtful, to be diversified. So within that, we would look for a broadening of the market. We would also look all around the world, because it is not just in the US. There's been a lot of attention there. It's not just in the US we find attractive opportunities.
Now, we surveyed the Fidelity analysts for this outlook, and they are definitely seeing more and more commercial use cases for AI across the board. What do you think needs to happen for the AI momentum to continue in 2026?
I think, so you could say this is the trillion-dollar question that our whole team is looking at and analysing really carefully. So if we think again where we have come from and where we're going to through 2025, as I mentioned earlier, you've really seen the usage increase, you've seen the use cases increase, you've seen demand very clearly building, you've seen supply constraints. For 2026, this is already known. So for 2026, our team is focused on the potential shift from more foundational AI to agentic AI. And as you'll remember, our analysts spend an awful lot of their time talking with corporates, doing field trips, trying to figure out what they are working on, what they're trying to do to improve their own profitability. And what they're hearing right now is an awful lot of different use cases that may indeed use agentic AI. And that includes things like fraud detection, things like energy efficiency across multiple different industries, process automation or product design. So if these use cases, these investigations, these trials actually take off, if they are productive, if they have a good return on investment and start to be rolled out across the corporate sector in multiple different sectors, that can really be a game changer. And the reason that can be a game changer is that agentic AI takes many, many times the compute power of more foundational AI, which means that this juggernaut of demand for AI can continue. And I said this is really important. You'll notice I said if. This is not yet proven. So we know the spend is happening. We know the CapEx is happening to a level that governments everywhere, economists everywhere are taking notice. We still do not have proof on strong and sustainable return on investment on these, on all of this spend that's happening. And I think that's a really critical point that will determine how this develops through 2026. And obviously, it's something that our team is looking at really, really closely.
Now, Matt, as Niamh mentioned, the US isn't the only centre of gravity when it comes to AI and for tech more generally. You're actually usually based in Hong Kong, so you've been watching the story unfold quite closely in the region there for this year. We know China gained a lot of ground early on in 2025. Can that strength persist?
In short, yes. I think the China tech story has been one where we look at markets on a fundamental valuation technical basis, and China tech was incredibly cheap last year, and you get that initial ramp up of as it started to participate in AI via DeepSeek and other areas. But actually, the fundamentals are pretty solid that sit behind it. Not only in terms of China's ability to participate in the AI cycle and find those efficiencies and drive it through the markets. There's also robotics is going to be a huge thing. I think it plays out in China in 2026. And then there's just the broader economy. I mean, I've just spent a week in China, and the adoption rate of a digital economy in China is remarkable. I recommend anyone to go and spend money in China, use the apps, use all of the EV cars. You'll struggle to not see a combustion engine in. And we're not just talking about Shanghai. You can go into the countryside and the story's the same. You can't use physical cash almost anywhere these days in terms of how things are. So China's incredibly adaptive at this, and I think that will play out both in terms of the economy and in the right companies in China.
There's been some significant sort of style shifts since Liberation Day back in April. What else does that tell us about the AI story?
Yeah, well, it's broader than that. I think there's been, if you look at factors within markets, they've deviated quite significantly. And some of the volatility we've seen this year has actually happened underneath the surface. So by example, since Liberation Day, a minimum volatility factor is underperformed by 20%. This type of move is moving it to 2 standard deviations away from the markets. And generally, when you see those 2 standard deviations moves, we see quite quick repricing. And what Niamh was just talking about is the AI story, but I think we're going to start seeing in 2026 thinking about AI as in how does it affect margins of other companies. And this might well end up being a stronger story. It's very hard to pick exact demand for AI infrastructure and how that's priced given current valuations, but I think we can get more certainty around certain industries having stronger margins in 2026, and so those broader industries can be supportive and close some of that gap.
Niamh, does that resonate with what you're expecting?
100%. I think we're at a time of heightened uncertainty in terms of the trajectory of fundamentals of many different companies. We're seeing some sectors that are at a big premium to where they've traded historically. We're seeing others that are even at a discount. But I think as Matt rightly identified, how trajectories in terms of revenue and margins progress in 2026 is going to be really crucial. So when I talk with our investment team, we have analysts and portfolio managers that are still finding really interesting opportunities within hyperscalers, within software, within semi-cap, particularly where the impact of AI has been misunderstood for those companies, but they're also finding value in really dull places, and particularly where opportunity is created in stocks that have really stable earnings, really stable cash flow, but they're not in the spotlight right now.
Yeah. Marion, let's consider the credit market. Salman made reference in his presentation. Spreads have been tight. There is definitely some widening now in pockets of tech. How well do you think investors are judging credit risk at the moment?
Well, if you look at valuations, indeed, they're very tight. You know, whatever market you look at, whether it's investment grade, high yield, and whatever geographies, we are pretty close to historical lows. I mean, in Europe, we are close to the 80 basis points if you look at the index, and in the US, a bit below that, close to 75, right? So from a pure valuation perspective, yes, I mean, the market is quite expensive. Now, if you look at the sentiment, it has definitely started to weaken. We see some concerns in the private credit markets, and clearly, you know, investors start to be really cautious when investing into credit. And if you look then at fundamentals, there has been indeed some areas of spread widening, and clearly there's a need for active management, right, and the right sector selection. So definitely what we've seen and what we've been doing in the portfolios is some slight widening in chemicals with, you know, poor earnings outlook, telecoms as well, suffering from, you know, pricing competition, and the consumer goods sectors, which are really some sectors that we tend to underweight. So you know, it really is important to have regular discussions, interactions with our analysts, and to ensure that we have the right sector selection and then the right bond selection as well within the portfolios. So at the moment, you know, clearly some sectors are still in a favorable environment from a fundamental perspective. So European senior banks, for example, and high quality tech bonds. And we also like double Bs, which have the potential to migrate. So there is a need for caution. But being in that interaction, regular interaction with analysts, make the right choices.
And how does that then reflect in the way that you're viewing sort of investment grade versus maybe high yield as we move into the new year?
Yeah. Well, what's important to look at is really the dynamics in terms of technical factors. And it's actually going to be quite different across the different geographies. If you take Europe, for example, investment grade is going to be pretty well supported by those technical factors, because if you look at numbers, the supply is rising by 5% only in IG. So that's a gross issuance of 630 billion, net only 25 billion euros. So that's actually a very low number compared to the historical average. Plus, we have definitely a favorable context in Europe. So I would say that's good news for credit markets in Europe. In the US investment grade, it's actually a bit different. We have net issuance which be up by 670 billion this time, so that's a 40% increase in net terms. So this is significant. And of course, my colleagues have talked about that, but obviously the trend that we'll monitor as well in credit markets will be the supply, which is linked to the AI landscape. We've seen, in October, the Meta deal, which was $30 billion, Oracle, 18 billion in September. So, of course, this will be also something which will be very important and which will probably drive not only sentiment, but also technical factors, and we'll see how that plays out. And finally, in US high yield, the issuance profile is a bit more supportive. We have only 5% of net increase in US high yield. So all in all, I think that's a pretty strong case for high yield. And especially we've seen that in terms of evolution of credit defaults, it's remained remarkably low. And another trend as well, which is really worth highlighting, is that we tend to see softer default events, in particular in Europe, which tends to mean that we have a recovery price which tends to be closer to 80 compared to the historical average of 40. So that's also a technical factor which plays really for high yield.
Oh, critical to all this is the inflationary backdrop. Salman, if we can take a look at that. I mean, the outlook appears fairly moderate, US, Europe, maybe even a bit lower in Asia. Does that align with your view? And if so, how do you see that feeding through to monetary policy next year?
Sure. So I think we have been in the camp and remain in the camp that the long-term average, this is the average which feeds into our capital market assumptions, will be around 3% US inflation looking ahead. In fact, a couple of years ago, we used to get a lot of pushback that this is away from the central bank targets. Now, I think people need to argue against us in the sense like, why do you think 2% is going to happen when there's so many forces which are taking shape, which are inflationary? So I think that's where, if I would put like a more medium-term hat on, I think higher inflation is here to stay for multiple reasons. And then central bank policy changes and the makeup of the central bank, especially in the US, is going to be an important one to solidify those trends. Because if you take a step back, as I showed in the charts, the private sector since 2008 has delevered, but total debt to GDP ratio is making new all-time highs. So the public sector leveraging has far outstripped whatever the private sector has done, and there is no appetite we see anywhere apart from UK. Because the market doesn't let them, to reduce fiscal spending and fiscal deficits. So that means so the independence of the Fed, the makeup of the Fed, potential change in the mandate of the Fed can be a very important medium-term forces which we'll have to deal with going forward. And that's where the biggest open risk, the elephant in the room from a macro perspective sits, which is the public sector leverage and how that plays out. And we think one of the ways it plays out is through higher inflation, which basically brings out, gives you out without massive political issues which are associated if you go through a proper deleveraging cycle.
Marion, if I can bring you in here, because the question around sovereign debt has been in the headlines this year, most recently in France. How are your portfolio managers approaching that asset class at the moment and looking into 2026?
Well, indeed, there are plenty of concerns regarding deficits, and in particular in France, it's actually big discussions have been happening for weeks to reach a consensus on the budget, and we're not there yet, right? So, and we know the UK is next in line, so, plenty of uncertainties when it gets to the US deficit as well. So obviously for the portfolio managers, it has a lot of implications in terms of outright duration strategies, and we tend to be underweight duration clearly. And we've done a survey as well, across the fixed income teams, and there is a pretty consensual view that the steepening trades will continue as well, based on those expectations of larger and stronger deficits. So, that's, I think, making another strong case for credit compared to government bond debts in the year to come.
Tied to the inflation question, Salman, obviously, is tariffs. We couldn't get away from them this year. But do you think that those effects are now broadly baked into markets, or are you expecting more volatility in the year to come?
So I think the markets did switch away from tariffs, and then, as Neil mentioned, AI theme was a powerful theme, and I think that sucked energy out of it. In the very near term, we still have to find out what happens to IEEPA, which is the broad-based authority that President Trump has been using to put tariffs. The initial indications are that it may get struck down. So you may get some short-term volatility as the administration tries to rebuild that tariff wall through Section 232, Section 123, or something like that. There are multiple ones. Mm-hmm. But it will take time. It's not, IEEPA is a broad-based authority. Without going into the legals of that, it's easier to do, whilst the other ones require investigation, proper case building, if you want to go beyond 15%. So we do think that the Trump administration is convinced that tariff policy works. I mean, if you look at the communication coming out of that, so we will think that will rebuild those walls. That may create uncertainty around some sectors because they may rebuild it through sectors rather than countries, because the other authorities give you more sector-related, freedom rather than country-specific freedom. So that's more on the short term. But we are seeing signs of pass-through building up in goods inflation. So January is going to be very important. So January effect has reappeared since the pandemic. So we know that from the tariff custom intake that tariffed goods have entered the country, but we are not seeing that pass through clearly. But Jan is when prices tend to reset once that inventory which was rebuilt or built in anticipation of tariffs also runs out. So Jan is going to be an important one from a tariffs perspective, but ultimately tariffs are here to stay, and this is going to be a fact of life for the global economic environment. There may be some volatility around it, but pass through we do think will build up, and that's another reason why we think inflation doesn't go much below 3%, and then has implications for the dollar as well.
Of course. Niamh, what about the analysts? What are they saying on the ground about margins, about pricing power?
Seb, yes, we have a monthly survey of the analysts, and we ask them questions exactly like this because it helps inform each other when we know collectively what's being heard, what's being said, what's being analysed, what's being determined for the future. So at the moment, what we're seeing from the monthly survey, firstly, global sentiment is positive, and that's true across all regions. But on the cost point, on the inflation point, there is an expectation or a trend towards improving on both non-labour and on labour inflation. If we put the two parts together, how I would understand that is that there is a view across corporates and across the analyst team that there is pricing power across the corporate sector, and that the economies, the consumers can bear them, that they're sufficiently robust. But if you'll allow me, I'll take the opportunity to mention a number of potential risks for the equity outlook. The first is that this is quite sector dependent. So when you have sectors like tech that are driving the earnings growth, they have really high incremental margins. So they're able to pass it on, absorb it, still get higher margins even while you have that rising cost. So as has been previously discussed, if that reverses, it can be a problem. The second point is on tariffs. Is it possible that we just haven't seen the effect yet? And we also know it was the dog that didn't bite in 2025, but it hasn't gone away, right? We're not all suddenly best friends everywhere, so this risk could come back. And the other point that I'm very conscious of, it was an important part of what we were discussing earlier this year, and it has quietened down. If inflation does come back, what it would do to longer bond yields is important for equity valuations. So again, we need to be really mindful of all of these risks into 2026.
Matt, jumping to Asia, export-driven economies everywhere you look. To what extent are tariffs a concern in the region, do you think, for 2026?
I think it keeps a certain amount of risk premium on very export-orientated countries that are exposed in that way. But quite a lot of Asia is exposed to the AI trade again, and there is actually some fiscal policy backdrops that have helped. So if you look at the likes of Korea, that was trading incredibly cheap, the policies there are very supportive of markets, making sure they're competitive, and they participate both in the tech boom, but in a broader activity way. Similar in Taiwan. So you need to be selective. I think we like to invest actively through Asia at this point, given this backdrop. But there are some bright lights that can go through. But diversification is a good thing too, because with this policy backdrop, you never quite know what's going to hit.
Salman, you mentioned the dollar. Obviously, tariffs play an active role in driving it down, and it's something that you've highlighted. Dollar depreciation is something you've highlighted as a key theme for 2026 in the outlook. What's your base case for the currency next year?
So I think we believe that we are in a multi-year down cycle in dollar. Dollar valuations, starting point valuations when tariff policies hit and everything was expensive. If you look at the various metrics we cover, technically dollar positioning may play a role in the short term. What happens to short-term Fed policy in the very short term? But beyond that, we think that a dovish Fed chair is coming. There's going to be a move more towards the employment part of the mandate rather than at the expense of inflation. So there's more structural dovishness there. Then you have the tariff policy and administration which wants a weaker dollar because they want to bring manufacturing back. So that means overall also a demand, if I were to add to another argument, is which we pick up and we are consistently picking up when we engage with clients, especially in Asia and some European countries as well, is this appetite to diversify their asset allocation, and a more obvious way to do that is through FX rather than taking a view on equities directly. So I think and on top of that, central bank demand for diversification continues relentlessly. I mean, they're still buying gold, and despite the wobbles, short-term wobbles we saw, this is a structural trend. So we do think that we are entering this multi-year cycle in the dollar. It will have cycles around that, mini cycles around it, but we do think this is a multi-year trend driven by a multitude of factors which are at play. So yes, for 2026, this is a theme we want to watch, but it goes beyond 26 to our mind.
Yeah. Matt, probably a good moment to bring you in from a multi-asset view, what this dollar story means from an asset allocation perspective. What alternatives might investors consider in 2026? What are you looking at?
In short, gold and absolute return type strategies. But if I could just add to the backdrop as to why and what in terms of that. One of the other things I think we'll see on the employment side is a bit of a white collar recession. We're already seeing it in numbers. There are graduate websites that used to have 200,000 jobs, they've got less than 50,000 jobs. If you look at the major service industry, a lot of graduate intake is down 20+%. It could be, and they're forecasting another 20% down over the next couple of years. There's a lot of around the AI story, but broader implications are kind of wait and see, and it's affecting white collar jobs. And I think you can definitely see over the next few years a weak employment backdrop with a strong capex backdrop, where the central banks choose to cut through that, even though inflation's at 3% plus with volatility around it. And that is a environment we have not seen as multi-asset investors arguably ever, if you will, and it could play out quite significantly. And that's why this is so important, because diversification between bonds and equities matters when inflation is volatile. It almost doesn't matter whether it's at 3 or 3.5 or 2.5. What matters is how much it goes up and down, and because if it's moving around a lot, they'll move together. And so I think I agree with Salman on the inflation backdrop, but it has that interesting, dynamic behind it, and that's why holding other real assets in gold and alternatives, but also within your equities, for instance, we really like transition materials, which is the commodities that are required to do all of this build out of all of the grid and other things, and that real asset element can play into this too.
Niamh, for regional equity positioning, what does a weaker dollar mean for you? I'm thinking maybe emerging markets. Where are you looking in 2026?
I think it's a really good highlight to the attractions of EM right now. So if we think about the headwinds that we've had, the reasons for having a low allocation to emerging market equities or for global investors not spending a whole lot of time there, we had a lot of reasons. So if you put the first two together, geopolitics and a strengthening dollar, those two were factors for years and years. Resources is a big part of many of those economies, was very volatile but rather directionless. And then you had the Chinese property market, which was really a dead weight on EM overall for many, many years. If we think about where we are now, I think the setup is a lot better, and the outlook for the dollar is part of that. Thinking about China specifically, I mean, Matt has very clearly articulated how strong and important the tech industry, the innovation industry is there. I would add to that also the anti-involution policy, which is really important for corporate earnings. This is the policy that the Chinese government is backing to stop race to the bottom competition. So, you have levels of competition in the market that are healthy, but you have levels that are unhealthy and that actually cause excess capacity, really weak margins. They're actively looking to stop that, which is a really important development in terms of thinking about overall profitability in areas like e-commerce. So for China, property market is, obviously it's not strengthening now, but it's no longer the big dead weight that it was pulling down the rest of the market. You have this strong competitive sector in AI, but in many related areas. You have cheap valuations. You have domestic investors that have started to realize this and really push the market higher this year, but the positioning from global investors is still really subdued. So we see a really good setup there. But when you look outside China to the rest of EM, it's also looking better, right? You have a lot of countries that have improved fiscal positions, but they benefit from what's happening on the dollar side because they have US dollar debt. They have exposure to resources, and the trends there are now improving. And all of these negative factors that were taking away the attention and the mind share of global investors, stop them looking to see that actually there are really interesting, strong corporates in many of these countries that are now starting to get attention again. So we think it's a really good setup into 26.
And just staying with dollar depreciation, Marion, from a fixed income perspective, how does that affect, you mentioned duration earlier, but I'm thinking, on other dollar denominated assets as well?
Well, there are different ways to, implement those type of strategies linked to this theme, which, I agree is going to be there for a few years. So I talked about duration, but there are also definitely curve strategies. So the, 210s has been actually remarkably stable over the past month. So there will be opportunities in that area. But we're also expecting the steepening between the 10s and the 30s to continue, especially on the back of some flows where we see foreign investors actually getting out of and reducing their holdings in US Treasuries. So there are curve duration strategies, which are obvious strategies to implement linked to that theme. But we also have a number of opportunities in the inflation-linked bond markets and the inflation swaps market as well. We talked about the inflation dynamics, but clearly, break-evens, cash break-evens actually really price very low levels of inflation on the long term. And as Matt rightly mentioned, what's interesting in the inflation markets is the uncertainty compared to the consensus. So that volatility of expectations makes it really interesting for fixed income portfolio managers to implement those mostly long break-even strategies, either through cash or inflation swaps. So plenty of opportunities in that space. And finally, we talked about FX, and those are the obvious ones to implement, probably much more on a tactical basis. But at the moment, clearly, Aussies, long Aussies versus dollar, long yen versus dollar are, some of the areas where we think there's a lot of value.
And I'm glad you mentioned the yen, because I do want to talk about Japan. It has been definitely a central theme to the outlook this year. Niamh, what opportunities are you seeing there as we sort of expect a sort of more strength and a sort of strong growth picture in 2026?
I think Japan is one that investors should focus on into 2026. I think of it as the tortoise to America's hare. You have two really important structural trends that are continuing. The first is the move against deflation. So that's been happening for quite a period of time, but it continues, and that's really positive in terms of, again, the pricing power of corporates and their ability to improve margins. But underneath it, the corporate governance reforms, the push for higher return on equity has not just started, but it's actually gathering steam. You're seeing those returns on equity coming up, and you're seeing a really big increase in stock buybacks this year, which for me is really positive. So Japan is coming from a lower starting point in return on equity compared to the US and Europe. But again, that's positive, because that means that the trajectory can actually be stronger. So the outlook for corporate earnings, we're quite bullish on it. The other point that I would mention is, the new Prime Minister, she is coming in the mold of Abe. She has stated that economic growth and investment are her priority. She is keen to have a really good position within AI, both for the sovereign and for the corporates. So again, with that kind of backdrop, I think, again, you've got a number of factors that mean that with a low valuation, you've got a good setup.
Matt, just quickly on Japan, close to where you're sitting in the world, any views on that country in 2026?
Yes, we like more domestic orientated stocks there as well. I think a lot of the policies will help the domestic backdrop and has slightly more certainty than the export part, which could do really well, but is a bit more volatile. So we really like Japanese mid-caps, for instance, given that policy backdrop and upside we can see.
Excellent, thank you. Well, we're almost ready to draw this discussion to a close. But before we do, I'm going to ask each of you for two convictions for 2026. And Salman, maybe if we start with you for your macro convictions for the year ahead.
Sure. So I think you have to watch the inflation side very carefully. As Matt mentioned, I think if it becomes more volatile, it can completely change the picture. As Niamh also mentioned, it can affect the long bond yields. We are in a very fine balance of AI excitement and actual facts driving that excitement and macro. And in fact, as I mentioned earlier, as macro folks, we are the ones which are quite worried that all this dance can start to reverse the other way. So I think in terms of conviction, diversification is your best friend. It is the only lunch. It's not the only free lunch. Think about gold as absolute returns, as Matt was mentioning. Have a holistic view at your portfolios because there are a lot of things in play right now.
Marion, I'm going to jump to you for your two convictions for the year ahead.
Well, first one, emerging markets, generally speaking, either hard currency, local currency, FX, because we have really good financing conditions, a weaker dollar, and actually quite a resilient domestic demand. And basically, those markets have been doing some structural reforms as well. They really want to ensure that they keep the access to international bond markets. And if you look at outflows over the past years, we actually have an investor base which is massively underinvested in this asset class. So this would be really my number one conviction. And number two, I've talked about that already, but inflation in bond markets, I think, will offer more tactical opportunities, but there will be really areas of opportunities there.
Thank you. Niamh?
For upside potential, I think it is worth having exposure to Asian and Chinese tech. We've already discussed, but I think there is within those regions the opportunity for really best-in-class companies at quite reasonable valuations. But I also agree with my colleagues. I would also consider defensive, income-oriented companies where you really have strong conviction in the sustainability of their earnings and their cash flow that give you that diversification and that defensiveness.
Thank you. And then Matt, finally.
Well, the nice thing is I like their trades because one of the things we do at Fidelity is the bottom-up analysts talk to the top-down analysts, and when they're confirming each other, that means we get really strong signals. So all of those sound pretty good to me, but I'll add playing AI via the build out of the grid and the power requirements and transition materials as one, and then Japanese mid-caps, that sort of decent diversifier if you think it's not that driven by all of those other themes we've talked about.
Excellent. All right. Well, that is all we have time for. Thank you to our panel and to all of you who've dialed in today. A recording of the discussion will be available on your local Fidelity website in the coming days, along with Fidelity's Outlook 2026. Don't miss it. Please do reach out to your local representatives if you have any additional questions. And before we go, one final request, there'll be a very short feedback form that will pop up on your screens. If you could just take 30 seconds to fill that out, we'd be most appreciative. Your comments and feedback are hugely welcome. Thank you again for watching. From all of us at Fidelity, goodbye.